Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host Jordan Rochester from the Global Markets Research team, and in this episode of our Fireside, I'll be talking with our US economics team with Lewis Alexander and Robert Dent on their thoughts for the US outlook this year with the upcoming new administration with President-elect Joe Biden. I'll be asking them what the current discourse in US politics will mean for the policymaking this year, what fiscal and also non-fiscal, the non-legislative policy we should expect in 2021, and finishing up on the risks to Fed policymaking this year. Will QE start to be tapered? And what does this all mean for the inflation outlook as well? So before we dive into the decisions you expect to see from Joe Biden's administration, Lewis, I just want to get a quick take from you on what the recent events in US politics could mean for policymaking in general. We'd expected a split Congress before the Georgia Senate seat results gave us that surprise with the Democrats. Now it's a 50-50 tie in the Senate and the VP as a tiebreaker. So in theory, Joe Biden and the Democrats should be able to get some of the policy done that we perhaps didn't expect for the next 2 years, or not. Have the results shifted? Is it just the same, or is the filibuster still going to be a problem, Lewis? What does Georgia's Senate result mean for you?
So the Georgia Senate results are important. They give the Democrats a majority, the narrowest of majorities possible, but that still does matter. First of all, it means they can control the process. So that's important for appointments, but it also means that they can bring up votes when they need to. As far as fiscal policy goes, it raises the potential for them to pass some fairly big things. To get around the filibuster, they'll have to use some of the special budget rules. You'll hear the phrase reconciliation used. It's a special way of, in some sense, getting around the filibuster. We do think that this means that we're likely to get substantial additional fiscal measures this year because of that change in the composition of the Senate.
So we're going to see some policy then, but what does that mean for your outlook in terms of numbers? So US GDP, we'll come to inflation later, so let's focus on the growth first. Does the stimulus lead to significant changes to your forecasts?
It does, actually. So we think we're going to get an additional $1 trillion in COVID-related fiscal support immediately. We think we're also going to get a longer-term infrastructure deal that's more on the range of $2 trillion. The combination of those two things we think are going to lift growth this year from around 2% on a Q4 over Q4 basis to about 4%, and keep it at around 4% next year. So it's material in terms of the outlook on growth.
Well, those are the sort of fiscal numbers, the growth numbers. What about the politics? This is a Pandora's box, really. The answer is going to be difficult. We saw last week's scenes of the protesters storming the Capitol building in DC. It's really unpredictable what happens next. We're recording this on the 12th of January. There's still the impeachment vote yet to take place if it does. So there's two questions to this. One, will Donald Trump face another impeachment trial, Lou? And the second one, regardless of what the answer is to the first one, will all of this weigh on any chance of getting bipartisan legislation over the line during the rest of this year?
So first of all, let me be clear. The thing we can be most certain about is as of noon on January 20th, Joe Biden's going to be the next president. There's no uncertainty about that. I do think it's likely that President Trump will be impeached, and we'll sort of go through that process again. It's unclear exactly how that's going to play out. There is a precedent for people being impeached after they've actually left office. And so that's all to be determined. I think in the short run, there is certainly the possibility that this will actually ease some of the partisan tensions. I think the reaction to last week's events is pretty significant. It's hard to overstate how big a shock that was for Congress. And I think in the short run, that has the potential to ease some of those tensions. Over the longer run, look, these are unprecedented events. It's very hard to know how they're going to play out. Our political system remains very divided. And so I do think those partisan divisions are going to be a constraint on policymaking going forward. But I think there's a decent chance that, at least in the short run, it'll be a little less of a constraint.
Okay, Rob, I want to bring you in here after what Lewis has said about the GDP outlook. I want to go into the details of the fiscal numbers because we're going to hear more from Joe Biden over the next coming days and weeks about their plans. But I want to get your idea for how that will feed through to the actual reality, and especially the second part of that story, which would be further fiscal stimulus in the second half of this year, not just the immediate stuff. So let's talk numbers. Fiscal austerity was the Achilles heel of global growth, with European fiscal prudence, where we are in Europe here, a particular drag over the past decade. The US had its own fiscal drag following the 2010 midterms with President Obama, and that only really came to an end when Donald Trump took office. Now, Joe Biden and COVID-19 is the situation right now. So the focus seems to be on getting a COVID-19 relief bill done. What numbers do you expect for that, Rob? And the other part of that is the infrastructure plan. What sort of numbers do you expect in the second half of this year when the infrastructure might take shape?
So thanks, Jordan. As you mentioned, there are really two important parts to Biden's plan. So the first is going to be this COVID relief bill that we're expecting in the first quarter of this year. The second is going to be kind of a larger infrastructure bill that has a little bit more of a slow burn that we think is going to take effect sometime in the second half. In terms of COVID relief specifically, we think Biden has a pretty straightforward blueprint to follow based on what's already been done. So we're looking for another round of stimulus checks. We think they're going to be kind of enough to move individuals up to around 2,000 on a means tested basis. We think Democrats are also going to prioritize state and local aid, which is something they tried to get done last year but couldn't due to not controlling the Senate. In addition, maybe additional support for small businesses. We could also see some more funding for testing and vaccinations. That's kind of the broad COVID package that we're looking for. We think is going to pass maybe around March. It's important to keep in mind there are a couple of pandemic unemployment programs that are going to be expiring in mid-March. And so that's really kind of the first deadline for them to meet. Now, that's going to be enough to kind of bridge the gap in terms of this significant lack in demand that the US is still facing because of the pandemic. But I think Biden is really going to prioritize kind of a large infrastructure bill during the second half of the year to provide longer lasting support. In terms of size, as Lou said, we're looking for something around $2 trillion. We think that's kind of close to what Biden proposed on the campaign trail, and it's something that moderate Democrats could rally around. The main problem, however, is that these Democrats are facing these very, very narrow majorities in both the House and the Senate. We think that means that they're going to have to kind of modify Biden's campaign proposals and just kind of bring them back towards the center of the political spectrum. That probably means more focus on kind of traditional infrastructure spending, like providing grants to state and local governments for surface transportation, maybe a little bit less of a focus on mitigating climate change and kind of promoting equality more broadly. Now, in terms of timing for infrastructure, there is this important kind of surface transportation bill that currently runs through the end of September. We think that's going to be a natural deadline for them to try to get something done around the $2 trillion range by the end of that month.
I've got two questions on that, Rob. You mentioned the stimulus checks. They'll be means tested. Is that a new thing, or were they means tested before?
They were means tested before. So right now, if you made up to $75,000 in the year 2019, so kind of pre-pandemic, you will qualify for the checks that they are sending out. The details really involve how they want to treat dependents, so people who have kids, things of that nature. The proposal that Democrats put forward back in December would add about $460 billion to top-line stimulus if they passed that. We think that's a little bit too ambitious. It's probably too generous to dependents, and so they're going to need to scale that back, we think, to something closer to $300 billion.
It's all amazing. The $800 billion that Obama did really gets put into comparison when you're talking $2-3 trillion. The other part of this is how to pay for it. So Joe Biden, is he still planning to raise taxes in the relief program? Is this something that's going to happen in the first half of this year? So could we see the corporation tax be increased like he set out in his campaign? Or is this something for the second half of the year or just not at all?
So I think there are three important things to keep in mind with taxes. The first is what Democrats will be talking about. The second is what they will actually try to pass. And the third is what's actually going to become law. So at this point, we think Democrats are going to start talking relatively soon about raising taxes. It's something that Biden talked about a lot on the campaign trail. He has a number of different proposals that would essentially increase individual taxes for high income earners and businesses, while at the same time cutting taxes for kind of low to middle income households. Those are things he talked about quite a bit when he was campaigning last year. We think it's going to start to come up as early as this week when Biden makes his new proposal for additional stimulus. So the talking part of it is going to be going on, we think, relatively soon. In terms of what Democrats are actually going to try to pass, it's a little bit more complicated. So passing tax increases in a COVID relief bill, I don't think is that palatable from a political point of view. Tax changes are very complicated. It takes time to come up with kind of legislative language. The COVID relief legislation is really ready to move right now. And so we don't think they're going to try to increase taxes as part of that. If they were to try to increase taxes, I think it's more likely to come under the infrastructure legislation that they're going to try to pass later this year. I think the main problem, though, is that moderate Democrats might not want to go along with some of the proposals that are currently being talked about. For example, some of the senators, such as Joe Manchin or Kristen Sinema, might say that they're not quite on board with increasing the corporate tax rate. And so that could be a sticking point in terms of actually getting these things done. At the end of the day, spending is just a whole lot easier than raising taxes. And I think, Democrats really aren't fiscal hawks. If they have to do their initiatives through deficit financing, that's something I think they're very much prepared to do.
This year really will be a high stakes game in terms of the politics. You mentioned the moderates there. I also think about the progressives. So convincing the progressives to do the stimulus without looking towards taxes, maybe it's easier than I'm implying, but it's definitely uncertain going ahead. And that uncertainty, Rob, applies to other things that are not just fiscal as well. There's a potential for surprises when it comes to foreign policy. We could see Joe Biden take a completely different direction on China. Or he could continue what Trump has been doing for quite some time and stay hard on China. So that's one of the questions we have this year. There's the idea of regulations for banking, for finance, for technology. And there's other non-fiscal policy agendas that could move markets. What potential surprises or one of those avenues, Rob, do you have your eye on? What do you think is some of the likely things we could see this year?
So I think the first thing that people need to keep in mind is that we're about to go into kind of the season of confirmation hearings for many of Biden's appointees and nominations to the cabinet. The ones that we're going to be particularly focused on will be USTR, Secretary of State, some of the other policy-related ones like Treasury Secretary. I think most of the domestic economic policy, we've covered already in terms of spending and tax changes. It'll be interesting to hear what former Chair Yellen says during her confirmation hearing, but I think there's much more uncertainty about what exactly is going to come out from the Secretary of State and USTR in terms of the U.S. policy towards China. That's one area that I think they're likely to take kind of a hard stance early on. They're going to have to figure out how to deal with a lot of these late stage actions that the Trump administration has taken over the past couple of weeks towards China. There are a number involving Taiwan. There are a number involving tech. Those things are going to come up during the confirmation process and are going to be kind of an early signal of what we should expect overall. We do think Biden is going to maintain a pretty hard stance, particularly in terms of human rights, technology, intellectual property. We think he's less likely to use tariffs, but these are things, again, that are going to come up during the confirmation process, and those will be important to watch. The other big thing to keep an eye on in terms of in terms of regulation is going to be what happens to the tech sector. As Lou was talking about earlier, the past week or so has had pretty significant implications for how to think about the outlook this year. One of the biggest is we've seen a lot of these tech companies start to ban President Trump from their platforms and take other action to kind of rein in these issues around speech over the past couple of weeks. These were issues that kind of existed before the turmoil in Washington, They were largely bipartisan. I think there is sentiment in DC that something needs to be done to kind of fix social media and to fix the kind of inordinate amount of power that these tech companies have. The recent actions are going to complicate that a little bit, but I think they're also going to add, some additional urgency to take a really hard look at the power of some of these tech companies and think about making some changes to competition.
Now, Lewis, I want to bring you in here in terms of, we've spoken about the plans for Joe Biden. Rob's gone through the sort of fiscal and non-fiscal policy we could expect next year. There's a narrative now taking place this early on in January, and the narrative is about the risk of inflation this year. We've seen over the past few years, central banks desperately try to increase inflation. We've seen quantitative easing, negative interest rates, TLTROs, and all of these different acronyms to try and boost lending as well, with the potential for COVID-19's base effects. So we're comparing inflation now this year versus the COVID-19 crisis earlier last year. That's going to boost inflation higher. And there's this genuine fear in the market of too much too soon. And we're seeing some comments from Fed policymakers lead to a questioning about what this means for policy. So far, it's playing out in US yields. We're seeing the long end rising in terms of yields, 10 years breaching 1%, 1.15% or so. Will the base effect in inflation, the extra fiscal policy stimulus we've spoken about, and also the bigger factor, which is the reopening of the US economy, hopefully, thanks to vaccines being brought out, will that bring a wave of long-lasting inflation in the US? What sort of numbers should we expect to see?
So I want to be clear, we're actually on the more conservative side when it comes to inflation. That reflects the judgment that the deflationary effects of this COVID shock are likely to last for a while. They're going to be particularly strong in rents. Now, having said that, you brought up base effects. It is important to recognize that some of the numbers we tend to focus on are going to be distorted in coming months because of what happened a year ago. So the cycle we had a year ago was in the height of the lockdowns, prices collapsed. We then had a very strong rebound in inflation in the immediate months after that. At some point in the year-over-year numbers, those months when prices were collapsing is going to drop out of the calculation, and we'll be left with just the very, very strong rebound over a short period of time. And it's likely at that point that our year-over-year measures of inflation in the U.S. are going to be at or above 2%. So things like the CPI year-over-year numbers that everybody focuses on could easily print in the low twos for a month or two as you get into that very unusual situation. Now, it's clear that that does not represent the momentum inflation going forward. And this is a place where I think the Fed's recent move to adopt average inflation targeting will actually help them. They'll be able to say very easily, look, we're not focusing on a relatively short period, we're focusing on this going forward. And I think they'll be able to make the argument that they can look through that. The broader issue is really how strong is the recovery, and how quickly does that translate into sustainable inflation. The recovery that's going to come really when, as you say, the vaccines start to mitigate COVID-19, and as we transition over the course of this year to an economy that is no longer constrained by the threat of COVID-19, that's going to have a very positive and powerful effect on aggregate demand. You combine that with what's going on fiscal, we're going to have a period of relatively rapid growth. To some extent, what's going to be a little challenging is that's going to be more or less coincident with these base effects. And so there is going to be a period when the economy is going to be growing very rapidly. Year-over-year measures of inflation are going to look like you're kind of at 2%. And that is going to be a period that is going to be a little complicated for markets. We're pretty confident that after you get through those base effects, inflation will come back down. And the underlying momentum in inflation is going to continue to be relatively modest, even with this strong recovery in the economy. We just think those deflationary effects are powerful. It's going to get into 2022 before you see a sort of sustained rise in inflation. So we still think, it's not really until 2023 that inflation is going to get up to levels on a sustained basis that the Fed is going to be worried about. But we are going to face this moment in the spring into the early summer when you're going to have this combination of year-over-year measures of inflation that look pretty high and significant momentum in the economy.
Indeed, it's going to be difficult for markets to ignore that. There's going to be this period of base effect inspired and fiscal inspired, peaks in inflation where it could be the case where yields do spike higher for a short amount of time before, as you described, inflation cools off. And that's, as you mentioned, the Fed. So average inflation targeting, it's going to help them through this. But this January, we've had some relatively hawkish comments. I mean, it's kind of helped the move in yields from Fed policymakers regarding tapering their quantitative easing purchases. So at the latest weekly numbers, the Fed is still outpacing their G3 peers. So the ECB and Bank of England did slow down over the Christmas period, where the Fed did keep things going in comparison. But it's also a period of COVID-19's fatalities and cases making record highs. And so it's just odd to me that it's January 2021. We're talking about how vaccines will make the future's brighter, hopefully. It's just odd to me that we're doing it so soon in terms of the hawkish talk. Yeah, fiscal stimulus is on the way, but the impact of lockdowns is also significant too. So, Lewis, am I wrong? Is the Fed correct to start to talk about reining in the stimulus so soon? Or is this something that is just noise for the time being and eventually it should sort itself out?
Well, the first thing to be clear about is obviously there are a number of policymakers. The FOMC is a big group. They don't all share exactly the same view. And what you've heard is a couple of participants that are more worried about sort of this transition away from maximum accommodation, who have started to talk about the prospect of taking decisions to reduce the pace of asset purchases in 2021. Yesterday, you had President Bostic of the Atlanta Fed also beginning to talk about the timing of the first rate hike. And I think you're absolutely right that the markets have taken that as a sign of, oh, gee, this walk back from accommodation could happen more rapidly than we had expected. I want to stress that I don't think those views really represent where the core of the FOMC is at this point. So you had Vice Chair Clarida on Friday giving a view that was more consistent with what we're expecting, which is not to see any reduction in the pace of asset purchases until next year, and stressing the fact that the forward guidance on short-term rates is going to keep rates low for a long period of time. We are going to continue to hear in coming days and weeks from both sides, and people are going to have to judge what's more important. We're going to get comments later this week from Clarida again, from Governor Brainerd, and from Chair Powell that we think are going to be more in line with this somewhat more delayed period. But I think the fundamental question is when you look out to the second quarter to the second half of the year, the outlook for the economy looks pretty strong. This combination of strong fiscal support that we think is going to come from the Biden administration, plus the prospect of a vaccine ultimately sort of reducing the threat of COVID-19. Those two things combined are going to be pretty powerful. And yes, the near term is challenged. And look, there's some risk in the U.S. that we're going to, face greater restrictions in the short run, greater social distancing that will have negative consequences on output in the coming, weeks and months potentially. But I think the further out you look, I think the more confident you can have of a positive outlook. And I think that's really what's driving financial markets at this point. So our expectation is that the asset purchases are going to begin to slow in next year, in 2022. We think the first rate hike is going to come at the end of 2023. So we have penciled in the first rate hike for the end of 2023. We do think it's going to be a slow process. So we think it's probably going to be something like 2 hikes a year for several years to get rates back up to a sort of more normal level. So not only is the starting of that process a long way off, I think the Fed has indicated that they expect to do it quite slowly.
I mean, last question of the podcast, Lewis. We had the subprime crisis in the US lead to the financial crisis. We had the financial crisis in the US lead to a global financial crisis, of course. That led to the euro crisis in 2010, essentially, and that kind of reverberated for nearly a decade. This COVID-19 crisis, we've had massive fiscal stimulus, massive monetary policy stimulus, and the vaccine reopening trade makes it hard not to be optimistic. I am optimistic as well. But is there any sort of risks in the pipeline, so credit related or politics related or anything that you think could change your view on the Fed there? So the tapering next year or the sort of rate hikes down the line, can that take place if you have another crisis? And what crisis would you expect to see? It's a tough question, I admit it, but I'm trying to think out the box here.
So there certainly was an acceleration in business borrowing ahead of COVID-19. And one of the, in some sense, surprises has been we haven't seen more problems in corporate credit this year. And it is certainly possible that there are a set of businesses that are facing longer run problems. And as we face the prospect of this period of COVID disruption lasting longer in 2021, that we could see more problems in that space over time. I don't think that's likely to lead to some sort of broader problem. I think the financial system is very well capitalized. I think the chances of a true systemic issue in the financial system, like what we saw a decade ago, is reasonably low, but there certainly are sort of additional risks around credit. Look, the U.S. clearly has a problem with inequality. That's something we've known for a long time that existed before COVID-19. And I think what COVID-19 has done is exacerbated those problems and made them more obvious. We've seen just in the last week that the potential consequences for this on our politics are hard to understand and potentially quite troubling. And so while I'm optimistic going forward, I think the system is resilient. I don't say that with the degree of confidence that I would like. And ultimately, I think the U.S. does face the challenge of trying to address the sort of inherent inequality in a way that mitigates those risks going forward. Look, I think that's very much what Joe Biden ran on. I think he very much wants to try and make a serious attempt at addressing those issues. As we've been discussing on this podcast, it's not easy. The partisanship around this is going to make it difficult to address those things. So it's hard not to sit here in the wake of what's happened over the last week and not feel some source of concern for how our politics is evolving. But I'm an optimist at the end of the day.
Well, on that note, thank you, Lewis, and thank you, Rob.
Thank you.
Thanks, Jordan.
So those are the views from us, those are the trades from us, and that's the Fireside with Lewis Alexander and Robert Dent from the US Economics team. Thank you for listening into the podcast. If you want to enjoy the show or hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one, and please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.